Well, it seems I'm late to the party. While everyone was discussing gold breaking through the $2,000 per ounce level, I was busy evaluating Chris Cole's Dragon portfolio. Don't worry, I didn't miss the event of gold breaking 2,000. I just didn't think it was particularly all that important in the grand scheme of things. I don't want to dismiss the fact that $2,000 is a big round psychological number, but 1,000 was much more significant from a psychological standpoint. Let's put this price into context. To do that, I like to look at ratios. We have to look at gold from the context of other things. I'm not making specific predictions here, only providing some perspective as to why $2,000 per ounce may not be where gold stops on its journey higher in terms of Federal Reserve notes. And remember, the Federal Reserve note is continuously being created to monetize debt, and so its value will gradually decline over time. Let's start with one of the charts that I favor. This shows how many times higher the U.S. debt is relative to the marked-to-market value of gold in the Treasury. As I've mentioned before, this is really a sign of the level of confidence the rest of the world places in the U.S. to be able to pay its debts. Prior to the end of World War II and the U.S. ascendancy to superpower status, followed by the signing of the Bretton Woods Agreement, the value of gold in the Treasury was such that it covered about 50% of the debt down to about 10% of the debt. After Bretton Woods, confidence in the U.S. increased over time, and the debt was expanded well above the ability of the Treasury gold to provide reasonable coverage. In fact, at the peak of confidence in the year 2000, the gold would only cover a little bit more than 1% of the debt. In between was the famous crisis of confidence, which culminated in 1980 in a gold price that put the gold coverage of the debt back smack in the middle of the pre-Bretton Woods era. So one might ask the question, if confidence in the U.S. is lost again, what would that mean for the value of the Federal Reserve note and thus the price placed on gold? It doesn't take much imagination to ask what would happen if confidence dropped down to the levels seen in 2011, immediately following the financial crisis. If this were to happen, the debt-to-gold ratio would drop from 49.75 to 36.25. This would imply a gold price of $2,800 per ounce. This is certainly a number that is hard to quarrel with. But what would happen if confidence was lost to the point where it took us back to 1980 levels? This is where it requires quite a bit more imagination. In this case, the ratio would fall from 49.75 down to 5.61. This would imply a gold price of $21,000. This is what many would consider to be an outrageously high number. And that's true, unless you consider how high the gold price would need to be to get back to prior troughs in the ratio. Let's take another look at a ratio that I like to review from time to time. This is the ratio of currency in circulation compared to the mark-to-market Treasury gold. As I've covered in previous videos, the physical Federal Reserve notes are what the Treasury considers to be the senior claim against the outstanding gold certificates held by the Fed, hence the relevance of the ratio. As we can see, since 1970, the ratio has fluctuated quite widely. When confidence was lost in the Federal Reserve note, the ratio dropped to as low as 0.7. At this point in time, the U.S. could have gone to a fully backed gold standard. Of course, we know that it didn't. Now, at the peak of confidence in the year 2000, the ratio climbed to close to 9. Currently, the ratio stands at about 3.74. What would happen if confidence declined to 2011 levels? As we can see, this would imply a gold price of $4,000 per ounce. Why so high relative to where we are now? Well, the answer is that a lot of currency has been created since 2011. Currency in circulation has doubled between then and now, and so to achieve the same peak price in gold in meaningful terms, the price would have to double from the 2011 peak. But let's let our imaginations run a little bit more and ask what would happen if we had a confidence crisis like what we saw leading into 1980. This would reduce the ratio from 3.74 down to 0.7. This would imply a gold price of $12,800 per ounce. Whoa, Belang P. When you gave us a price based upon the U.S. debt level, you said $21,000 per ounce. Now you're saying $12,800 per ounce. These ratios are useless. Good point. But don't forget, these ratio levels are assuming the debt and currency in circulation remain stagnant in the future. It's a safe bet that they are going to grow. I'm not confident enough to make a John McAfee type bet where if certain levels aren't hit by the end of the year, I'll eat a part of my anatomy that I greatly treasure. However, I would be willing to make a video of myself standing on my head and singing Yankee Doodle if the debt and currency and circulation levels don't increase between now and the end of the year. But seriously, all it would take to bring these gold prices in line is for the Federal Reserve to go into overdrive and print like mad to monetize newly issued Treasury debt. This would increase the gold price based upon currency and circulation and bring it closer to the price based upon the U.S. debt target. Let's turn our attention briefly away from metrics based upon the soundness of the currency and towards the confidence placed in the stock market. As you can see here, this is a chart of the S&P 500 index price level compared to gold. It too has fluctuated quite a bit. I wouldn't put too much emphasis on dates that go back several decades. After all, it is well known that the combined value of American businesses is much higher than it was decades ago. Still, this chart is useful from the standpoint of timing and intermediate-term price levels. If we ask ourselves, what would it take to bring ourselves back to the extreme seen in 2011, the answer is that the S&P 500 to gold ratio would need to decline to 0.7. At its current 1.64 level, this would require a gold price of $5,600 if the S&P 500 index doesn't drop. So to summarize, do I think $2,000 is a special level? Not really. As far as big psychological levels are concerned, I'd be more focused on the $10,000 level. Will we get there? I don't know. I guess a lot of it will depend upon how crazy things get in this country.